Good morning, everyone. Today we're diving into a story that's been making headlines and affecting wallets around the world. Oil prices have been on a wild ride this week, jumping up one day and settling down the next. It's been a true roller coaster, with dramatic swings that have left both investors and everyday consumers on edge. The global oil market is incredibly complex, influenced by events far beyond our borders. Every shipment, every policy change, and every international headline can send ripples through the system. On Monday, oil prices surged over 2%, grabbing attention from Wall Street to family budgets. Suddenly, everyone was talking about what might come next. By Tuesday, things calmed, with prices hovering just under $62 a barrel. The market seemed to catch its breath, but uncertainty lingered. This kind of back and forth is called a market correction. Traders pause, reassess, and react to the latest news. It's a moment when everyone tries to figure out what's really happening beneath the surface. The oil market is like a sensitive scale. Supply on one side, demand on the other. Even the smallest shift can tip the balance, causing prices to move sharply. Major news, especially from big oil-producing countries, can tip that scale instantly. A single announcement from OPEC or a sudden disruption in production can send prices soaring or tumbling. This week, headlines from Russia and Ukraine, plus rising tensions in the Middle East, added layers of uncertainty. Geopolitical risks are always lurking, and they can change the outlook in a heartbeat. Each story makes investors question whether the world's oil supply is at risk. When supply feels threatened, prices react quickly, sometimes before the facts are even clear. The result? Prices swing as the market tries to separate real threats from background noise. It's a constant battle between fear and facts, and the stakes are high for everyone. Understanding these factors helps explain why you pay what you do at the pump. The price you see isn't just about oil. It's about a world in motion, reacting to every headline and every rumor. Let's break down what's driving these dramatic moves and see how global events, market psychology, and supply and demand all come together to shape the price of oil. The big shock this week came from Russia accusing Ukraine of attacking President Putin's residence. The Kremlin released dramatic footage, claiming drones targeted the heart of Russian power. This accusation wasn't just a local story, it immediately grabbed the world's attention, fueling speculation and concern about what might come next. Such a claim instantly rattled global markets, raising fears of escalation. Investors and analysts scrambled to assess the risks as stock prices dipped and uncertainty spread across financial centers from New York to London. Ukraine denied the accusation, calling it baseless and suggesting Russia was trying to disrupt peace talks. Ukrainian officials insisted they had no involvement and accused Moscow of using the incident as a pretext for further aggression or to sway international opinion. This back and forth created confusion and uncertainty, making it hard to know what really happened. News outlets around the globe scrambled to verify facts, while ordinary people watched anxiously, unsure who to believe or what the next day might bring. The U.S. quickly got involved, with President Trump expressing anger but also hope for peace. American officials called for restraint, urging both sides to avoid further escalation, while also warning of consequences if the situation spiraled out of control. This mix of tension and diplomacy left the world on edge. People everywhere wondered if this was the start of a larger conflict or just another chapter in a long-running standoff. Russia is a top oil producer, so any threat of conflict or sanctions can disrupt global energy supplies. The world relies on Russian oil, and even the hint of trouble can send shockwaves through the energy sector. That's why a single headline from Moscow sent oil prices soaring. Traders reacted instantly, bracing for possible shortages or new sanctions that could squeeze supply. The takeaway? Even rumors or accusations in this region can shake the oil market. The stakes are high, and every development is watched closely by governments and businesses worldwide. The risk of escalation is always lurking. Military buildups and tense rhetoric keep everyone guessing about what might happen next. For oil traders, uncertainty is the real enemy. In a world where headlines can move markets in seconds, staying informed and prepared is more important than ever. Why does Russia-Ukraine tension matter so much for oil? Russia is a top 3 oil producer, supplying much of Europe and beyond. If conflict threatens Russian oil flows, the world gets nervous. Sanctions or fighting could cut millions of barrels from the market overnight. When supply drops but demand stays steady, prices rise. Basic economics. Pipelines crossing Ukraine are especially vulnerable. Any damage could disrupt energy supplies for months. Even the threat of disruption adds a risk premium to oil prices. Russia also supplies natural gas, especially to Europe, so any conflict could force countries to burn more oil instead. The result, potential supply shocks and demand surges, both pushing prices higher. That's why every headline from this region matters. The oil market is always watching for the next flashpoint. Stability here means stability at the pump. Trouble isn't limited to Eastern Europe. Yemen is heating up too. Saudi Arabia and the UAE, usually allies, are now clashing in Yemen's civil war. This rift between two OPEC heavyweights signals instability in a region critical for oil. The Middle East holds much of the world's oil, and any sign of discord can rattle markets. If Saudi and UAE cooperation breaks down, OPEC's ability to manage supply weakens. That could mean unpredictable production and wild price swings. Investors worry that regional disputes could spill over into oil policy. In the oil world, unity among producers is key to market stability. Iran is back in the spotlight, adding to market jitters. The U.S. warned of major action if Iran resumes its missile or nuclear programs. Iran's oil exports are limited by sanctions, but its strategic location gives it outsized influence. The Strait of Hormuz, a narrow waterway Iran could threaten, carries a fifth of the world's oil. Any attempt to block it would cause a global oil shock and send prices skyrocketing. Even without exporting much oil, Iran's military power keeps traders on edge. The risk of conflict here is low probability, but high impact. That's why every statement from Washington or Tehran is closely watched. The market never fully relaxes when Iran is in the news. With all these global tensions, why aren't oil prices exploding? The answer: there's plenty of oil on the market right now. The world is actually oversupplied. Producers are pumping more than we're using. This surplus acts as a cushion, absorbing shocks from bad news. Think of it like a grocery store with overflowing shelves. No need to panic buy. The fear of future disruption is real, but today's abundance keeps prices in check. The market is caught between fear of what might happen and the reality of current oversupply. For now, the surplus is winning, keeping prices stable, but that could change fast if a real crisis hits. Stability is fragile in the oil world. Let's dig into this oil glut and see what's really happening behind the scenes. The world is awash in oil, and it's changing the way the entire energy market works. The U.S. has become a top producer thanks to fracking, transforming global supply. American innovation in shale extraction has unlocked vast reserves, making the country a major player on the world stage almost overnight. American oil acts as a buffer, making the world less dependent on any one region. Shipments from the U.S. now reach markets that once relied solely on the Middle East or Russia, diversifying global energy flows. Other countries are also pumping at high levels, while demand growth has slowed. Nations like Saudi Arabia, Russia, and Brazil are all producing near-record amounts, adding to the global surplus. Economic slowdowns in Europe and China mean less energy use. Factories are running below capacity, and transportation is down, so the world simply isn't burning as much oil as before. The result? More oil produced than consumed, with the excess going into storage. Every day, millions of barrels are added to already brimming tanks. Storage tanks are full, giving the market a sense of security. There's a visible cushion, a safety net that reassures traders and governments alike. Even if there's a disruption, reserves can cover shortfalls for weeks or months. Strategic reserves and commercial stockpiles act as insurance against sudden shocks. This inventory overhang is a powerful force keeping prices in check. With so much oil on hand, it's hard for prices to surge, even when headlines turn dramatic. It's a strong counterweight to geopolitical fears. News of conflict or unrest doesn't send prices soaring the way it once did. The oil glut means less panic when trouble flares up. Markets stay calmer, and consumers benefit from more stable prices at the pump. But if demand suddenly rises or supply drops, that cushion could disappear quickly. The balance is delicate and the market can shift in a matter of weeks. For now, it's the main reason prices aren't spiking. The world's oil glut is both a shield and a warning, reminding us that today's abundance could become tomorrow's challenge. What's next for oil prices? Most analysts expect stability in the short term. U.S. oil is likely to trade between $55 and $60 a barrel. The oil glut is keeping prices from rising, while geopolitical fears keep them from falling. Looking ahead, some predict prices could drift lower as oversupply grows. But if conflict erupts, Russia-Uraine, or a Middle East crisis, prices could soar overnight. These black swan events are unpredictable, but have huge consequences. For now, cautious stability rules, but volatility is always a headline away. The market balances known oversupply against unknown risks. Traders are ready to react instantly to global news. Oil prices are always at the mercy of both economics and politics. So what does all this mean for you? Stable oil prices mean steady gas and heating bills. Good news for families and businesses. Predictable prices help with budgeting and keep the broader economy on track. But this stability is fragile. A major crisis could quickly drive prices up. That's why global events matter, even if they seem distant. The current oil glut is a cushion, but it could vanish if conflict erupts. For now, enjoy the calm, but stay aware. Our daily lives are closely tied to the world's energy and politics. The balance could tip at any moment. The story of oil is always changing, and so is its impact on your wallet.